Hi guys, thanks for tuning in to another episode of Nuggets News, or our monthly housing and economy update with our friend Martin. How are you, Martin?
Yeah, I'm pretty good, but swimming against the tide. There's just so much data. It's a torrent of data coming at the moment, and it's really tough to sort of separate the sheep, sheep from the goats, the wheat from the chaff. Really.
Yeah, we said it was probably going to be a big month, and it has been. So we've got some slides to get through, and a couple of things that have, I guess, that we spoke about last week or last month have started to come into play in terms of the bond market and starting to rescue different central banks. And I want to talk about at the end. You've got some slides there about bonds and really tie that together to what's coming next, I think.
Yeah, I think that's right, and I think it's important to have a forward view as well as a rear view mirror view because it ain't over till it's over.
Okie dokie. Let's get into these great slides of yours as always. So the RBA have been very vocal about their house price forecasts and how much they've changed recently.
Well, it was actually all forced out by freedom of information from Chris Joy. Chris about 6 to 9 months ago said, hey, he thinks prices are going to fall maybe up to 25 to 30%, and that's because of interest rate rises. At the time, the RBA was saying, no, there's nothing to see here. It might be a couple of percent, not much more. And then they came out a bit later with another, well, maybe it'll drop by about 11% over the next couple of years. And more recently, they seem to be modeling that it's nearer to 22% or 20%, depending on how you do it, right? And in fact, if you look at the freedom of information, you can see that they're trying to react to what Chris Joy was saying, because effectively they're using the same modeling from a guy called Tulip, who used to work at the bank and now is out of the bank. And Peter Tulip's model basically has some connection with interest rates, right? So basically, Christopher Joy's argument, my argument, and in fact the RBA is now saying when rates go up, property prices fall. The more rates go up, property prices fall farther. So therefore, this idea that magically property prices aren't going to fall, even the RBA has now debunked it. We're going to see property price falls. The question is how far they will fall, how fast they will fall. And that's all connected directly with where interest rates are going to go. And of course, there's a discussion tomorrow. We'll know whether they're going to put the rates up again. And there are two reasons. The first is that borrowing power is reduced. So that's how much you can get for the same amount of income and expenditure. If you compare it today with where it was before the rate rise started back in May, borrowing power on average now is down about 30%. So people can borrow around 30% less for the same parameters. Now, the banks are trying to mess around. For example, they're saying, well, maybe we'll consider doing 40-year loans rather than 30-year loans, right? Or maybe we'll offer you interest only rather than principal interest. And maybe you can use superannuation to pay off your mortgages later on. But that isn't going to be enough to save property price falls. Neither will migration. Of course, they've amped up migration now. But migration is not necessarily going to be sufficient to save price falls. So even the RBA is saying property prices are due to fall further ahead. The question is, of course, how far?
Yeah, I've read some of Dr. Tulip's work, and it's interesting that because we speak about how the RBA is sometimes saying one thing because they're one of the games they like to play is that confidence game, but behind closed doors and now through Freedom of Information Act, we see that they're also forecasting, but they don't want to come out and say we think house price is going to fall 20% because it creates a panic and destroys that confidence. But yeah.
And it's interesting that the Federal Reserve, which of course is also on the rate hiking cycle, actually overtly said they need to see property prices correct in the US because they regard that as one of the key indicators of an overheated market. And they also at the same time said, and if financial markets ease back, that's actually good as well. So it's almost like, well, the Federal Reserve is recognizing that high property prices, over high property prices, and overinflated equity markets are actually a problem. In Australia, of course, we don't get such clarity from our central bank, nor indeed from our treasurer, with regard to what's going on. But let's face it, property is in a bubble, equity markets are in a bubble, simply because of those ultra low interest rates. Now interest rates are going to go up. Expect to see more corrections later.
Yeah, and in this debt-based system, we need to keep borrowing more, and that's why we're seeing things. I think there was even a proposed scheme the other day where the government might help you with a quarter of your cost of the house, but then they'll get the capital gains in future. So there's all these things where they're trying to say, well, how can we sort of keep the game going? Because if you let it fall, it all comes collapsing down.
Yeah, it's a sort of game of spinning plates, right? So you try and keep all the plates spinning, and you have to keep, a bit harder and harder and harder. But eventually, it's happened. And in fact, if you look at real data at the moment on property price falls, Brisbane is falling fastest. Some of the other places, like Adelaide, a little less so. But prices are already down, in some cases now 15% from their peaks. Now, we had a big run up last year, of course, but we're going to see a further fall. And so anybody who's believing that we've suddenly got to the bottom of the house price fall sort of stage of this is kidding themselves, not least because the RBA is still looking to raise rates further ahead. And when rates are actually as high as they are, borrowing power is reduced, but it's also going to stay there for a long time, as we'll see later, because inflation is still very sticky.
Okay, so consumer confidence has rolled back over.
Yeah, and this is quite important because one of the indicators that we should be looking at is how consumers are behaving. And again, what we're seeing is that consumer confidence is now at levels, well, pretty close to where it was in the global financial crisis. Not quite there yet, but if you look at decisions to buy a large item or to buy property, they're way down from where they are. So clearly, households are reacting to the new environment that we're in with higher interest rates. And whilst employment is still pretty good at the moment, and whilst the number of jobs available is still pretty good at the moment, real wages aren't growing. Households are being certainly steered towards a more negative environment, particularly because of all the talk about what's happening with house prices and I think the global situation. But I think also, very importantly, the energy discussion. And of course, the budget came out last week and said that energy prices will be going up again significantly over the next year to year and a half. And in my surveys, I continue to see huge pressure on households in terms of all the spending categories. And that's not then surprising why people are saying, well, everything's gone up, but my wages aren't going up. Therefore, I'm going to be a bit more cautious about where I'm going to spend, what I'm going to spend. And not surprising when you see property prices also sliding, that confidence is, well, frankly, in the gutter.
Yeah, that's one thing I like about Jim Chalmers is the honesty when he said, we could be looking at energy bills 50% higher coming pretty soon. So you don't often get that honesty and transparency from officials these days.
No, and I think the budget was quite interesting because there were a number of thematics coming through, which I think was a much more objective view of where we actually are. And of course, they are forecasting lower prices for our exports, particularly iron ore. And of course, we've seen the iron ore price slide recently. And they're talking about structural deficits still being there 10 years down the track. So as yet, they're not really doing anything, though, to tackle the structural deficit that we've got. And he's recognizing that even now, many households are actually in difficulty. But he also made the point that we can't just throw more money into the system like the other government did through COVID, because that will just create more inflation. So therefore, they've got to use different levers this time. And that's why they're talking perhaps about thinking about whether they can find a way to control the price of gas. The reason that's so important is that not only is the gas price itself going up, but it's the marginal price of gas that drives ultimately the price of electricity. And of course, electricity then feeds through into everything else. So if those prices go up the way that they're now being predicted, not only will businesses go under, but also, inflation will stay high for a lot longer. And I think sticky inflation is the underlying thematic of this conversation, actually, because wherever you look, inflation is not transitory now, it's sticky, and that's going to put huge pressure on budgets. In fact, if you look at the amount that the budget is now forecasting to pay ahead in terms of the cost of debt to the government, it's probably one of the biggest elements in the budget now. So it's a big issue. But, consumer confidence is a very good leading indicator.
Yeah, and you've got that in some slides here in a second as well. But superannuation returns have turned down.
Yeah, I thought this was interesting because I've had a number of people grizzle in recent times saying, "Oh, my superannuation is doing really badly. I went to cash, some months ago, and my superannuation is still doing really, really badly. What on earth is going on?" And of course, there's three observations. Firstly, there's more than 3 trillion in superannuation, and by the way, the government's eyeing some of that to throw it into the housing market later, which is another sort of strategy to try and support the housing market. But the value of superannuation has dropped. In the last quarter, this is APRA data, to June, it was down to more than 4%. Now, what's interesting about that is that was before the most recent falls in the markets. And we now know that since then, value of superannuations continue to fall, in some cases quite dramatically. And even if you are in a conservative fund or a cash-based fund, you're still actually paying fees to these superannuation entities in an environment where, frankly, it's going backwards. And I keep asking the question about, well, who is the superannuation system actually working for, right? It's working for the financial system. It's because they're still paying, 30 billion of fees per annum going to the people who manage the superannuation system. But is it working for individuals? And by now being forced to put an ever larger proportion of your income into superannuation because of the government scheme, is it really benefiting? And then I come back to my point I made earlier on. I'm hearing that some banks are now saying, well, what we'll do is we'll go on lending on interest only until you can get to access your superannuation. At that point, you'll be able to use superannuation to repay your mortgage, right? So that might solve the mortgage problem, but it won't solve the old age pension problem. It will just put more pressure back on the government. So I have to say, this whole superannuation system, to me, is now creaking at the seams.
Yeah, we've seen research papers over the years talking about how a lot of these active funds and where all the fees get extracted from really outperforms just the index itself or whatnot. So, yeah, who does it benefit, as you say?
Yeah, and in fact, Senator Rennick last week had a really good rant in the Senate. I recommend you go and listen to his 9 minutes on this, because he basically said this is, an amazingly bad system we've got. And actually, he's onto a good point. Not, of course, that many of those in authority will want to recognise, other than the superannuation system is, an institution that's worthy, 3 trillion compared with 10 trillion in property. But there are some serious questions to be asked, I think, in this whole thing.
Yeah, the other point just to touch on that you mentioned is a lot of people will go into what they view as a safer or more defensive fund, but a lot of the time they're in cash equivalents and bonds and those sort of things. So if the price of these bonds also takes a hit, it's not the same as actually sitting in physical cash, even though these things are often named, cash or cash equivalent. So people think, I'm going to retain 100% of my capital, but it's not really how it works.
Yeah, and of course the bond market has not behaved like it normally does, which is sort of a counter move to equities. In fact, bonds and equities are both down. In fact, pretty much all asset classes are down. So that's the problem.
Yeah. Okay. Moving on. So the RBA cash rate's 2.6 and still predicted to get up towards 4%.
So this is what the market's saying. Of course, what happens tomorrow? Is it going to be 25 or is it going to be 50? Of course, last time the RBA did 25 rather than 50 basis points. I suspect they'll do another 25, but the inflation was so hot that you could argue they should be going stronger and harder, as, for example, in New Zealand, they're still pushing pretty hard, and in Canada, they went pretty hard, just not quite as hard as previously. And of course, the Fed is also expected to continue to hike rates. And of course, the more that other organizations and other central banks around the world lift rates, that's going to put ever more pressure on the RBA. So the market has come back. It was actually at 4.3%. At the worst, when the bond markets were all over the place 2 or 3 weeks ago. It's come back to 3.8%. But just to be clear, the bond market in Australia is saying the cash rate could be around 3.8% in March 2024. So add 2.5% to 3% of that. That'll tell you that the mortgage rate is expected to stay high for quite a long time. So all of the property spruikers who are saying, this is just a temporary thing and property prices are going to actually recover and interest rates are going to come down and mortgage rates are going to get cheaper. It's not what the markets are saying. We're in a completely different environment now. And so the RBA will probably continue to lift at whatever rate for the next little while. And most of the main economists now are suggesting that it'll be, significantly harder than they were saying 2 or 3 weeks ago. Even the CBA is now taking it over to 3% as a terminal cash rate. So rates are going higher, folks.
Yeah, I think to argue the property is going to go back up, I think you have to argue as to why rates aren't going to keep going up, because I just don't think those two can coexist unless they introduce new radical schemes or something like that. It's just not going to work that way.
No, and even if they do those radical schemes, I think it's going to be too marginal to be really effective.
Offset it, yeah.
It really is all about interest rates. So the path of interest rates will determine what happens to your superannuation, and it will also determine what happens to property as well.
Yeah. So we've seen wages. I'm surprised that wages are even trickling up this much. I guess it's been a competitive labour market, as you say, but still nowhere near as much as CPI.
Well, this is from the budget papers, and this shows that there's no expectation of real wages growth anytime soon out into, the midterm. That's all. Maybe in, a couple of years' time we might see it, but that, of course, is all predicated on inflation coming back down. And, inflation, as we'll see in a second, inflation is still horribly hot, broad, and sticky. So the chances of inflation going to come on down anytime soon. And it's because a lot of people are still wedded to this idea of the base effect. So the idea is that when rates go up or inflation goes up and then it stays level, eventually those lifts drop out of the calculation and therefore it automatically comes back down again. So that's the base effect. But the trouble is there are new forms of inflation and new forces of inflation already in the system. So the chances of inflation coming back down soon under the base effect is quite low now, despite the fact that many economists are still holding to that as the reason why inflation will be better later.
Yeah, and so monthly we had another uptick in CPI.
Yeah, so this was 7.3%. This is the one for September, stronger than expected. One of the reasons why some people are saying, well, maybe the RBA will do 50 basis points rather than 25 because it was a lot stronger. And it's worth just reflecting that the budget papers assumed 7.75% peak CPI. This was before the CPI number came out. But if we're at 7.3% now in September, there's not much headroom. So it could well be that, in fact, inflation remains stubbornly higher for longer, which puts more pressure on the RBA and, of course, on households.
Yeah, and as you mentioned before, some of the sticky inflation and non-discretionary items moving even more.
Yeah, this is the most scary slide in the pack, I think, from the ABS, and that showed that the non-discretionary things, these are the things you have to buy, just to continue to live, food and those sorts of things, was at 8.4%. 8.4%. That's huge, right? That is so far above where wages growth is. And of course, many people aren't seeing any wages growth at all. This is a really big deal because what that says is that the things you've got to buy are now really, really hot. And the problem is that the things you choose maybe not to buy any more of, inflation's only at 5.5%. So it's now got into the part of the economy where everybody is being hit left, right, and centre. And I see it in my surveys, whether you look at food, some categories of food were very, very high, of course. Plus, of course, we've got the disruption from the floods, which is going to actually put more upward pressure on food prices over the next few months, as well as energy that we touched on earlier on. And even the adjustment down in fuel has not really helped that much because whilst there was a drop, now we're starting to see it come up again. And of course, we've got the exchange rate moving against us. So in the US dollar terms, our petroleum is still very high, and that's going to put more upward pressure on transportation. So wherever you look, inflation is embedded and it's strong. Therefore, if the RBA is serious about conquering inflation, and they keep saying that they are, then the only way is to do that is to put interest rates up even more.
Yeah, and that's when you talk to people in the real economy where they're running a cafe or a farmer and their input costs start going up and their energy costs are going up. So then they've got to put up the price of their products. It all just feeds through. And once it's in the system and everyone has started to charge more for their items, that's what we refer to as sticky and it's hard to unwind.
It is, and it gets embedded. And of course, the other observation on wages growth, there are some sectors doing very well, like, for example, traders in the building and construction industry. They've had significant wage rises because there's a huge shortage and huge demand, right? But if you look in some other sectors of the economy, for example, in some of the healthcare sectors, there's been really no increase in wages over the last 2 or 3 years, even with the recent award levels. So what that means is that we've got an unequal distribution of wages growth, and therefore this inflation that we're talking about here is disproportionately hitting some households rather than others. And often those households are the ones with more limited incomes and less ability to be able to actually make alternative choices. So we're seeing this diversion, again, this divergence between those that are actually doing pretty well and have buffers and, where they can refinance and pull more equity out of the property and carry on, and those that can't. Unfortunately, it's the can't group that's getting bigger, and just they're not keeping their heads above water, and that's where a lot of the pressure is going to be, I think.
Yeah, and I think it's important to talk about the longer term structural impacts that has, where if banks are lending more, and we're closer to the money taps, the cancel on effect that we talk about. And so there's all these tradies that are earning a lot of money, but that's for a house, and that's a future profit for 30 years for a bank. But then we're seeing doctors, nurses, pharmacists, and these health professionals that haven't seen wage increases. The great resignation, people are leaving these jobs. But if that means that more people are sicker and we don't have a good healthcare system, that ends up being huge cost to the government further down the road. So it's interesting to see how those things balance out.
Yeah, and of course, there's a big discussion about the funding for the NDIS, right, which is now one of the biggest drains on the budget, or one of the things that's really important for many people. But they're now saying, well, they're going to try and find ways to get more efficient, et cetera, et cetera. But if you think about the cost of servicing the debt that's now much higher than it was, and the NDIS and a couple of other big categories, healthcare, for example, we've got huge drains on the budget, but we've still got this structural deficit. So there's no attempt at the moment from the government yet to think about what levers. So, things like maybe excess windfall profits on the oil companies or things like that, they have to be on the agenda here unless we actually continue to see this, fragmentation of society. So, proportion doing really well and the other proportion not. That for me is not just, it's not fair, but it means there are some really tough decisions ahead. So I hope that the Treasurer will continue to be transparent about his decisions, but also we have to have some really important discussions here in Australia about the future of society and the way we're going to fund our lifestyle ahead.
Absolutely. GDP forecasts, Martin?
Yeah, so just on the budget again, the GDP is forecast to drop back. So the growth rates that we had are looking very uncertain ahead. That's partly because there's an expectation of potentially a recession, maybe in the US, maybe in Europe. We know that China is locking down again. We know that the price of iron ore has dropped again. Almost wherever you look, you can see more pressure on the overall budget. And so the GDP, the question now becomes, well, will we actually manage to stay out of recession or not? Now, at the moment, the budget paper said we'll just about stay out of recession, but it's pretty, finely balanced at the moment. And I think if things move a little bit more negative, as they could do, recession is still possible. But the global story is not good. The IMF and some other institutions globally are forecasting significant slowdowns and significant recessions in many parts of the world. And Europe looks to me to be where the story is the weakest and there's more likelihood of recession. In fact, some people are saying the UK could already be in a recession. Other parts of Europe could as well. The US, of course, escaped because the GDP number was a bit stronger this time around. But who knows quite how this is all going to play out, because the GDP number does wobble around a bit, and that was only the first estimate. Interesting to see what the second estimate is later.
Yeah, I definitely think even the rate rises we've done so far is going to absolutely slam the brakes on economies, and most developed economies will go into recession. It's probably even worse for those developing nations. So that's kind of the way I'm viewing things, and that'll be their excuse to come out and lower rates again and try and print more money. But now we get to these slides in a second about the bond market and how that's going to play out if they have to do that.
Yeah, and just on China, I thought I'd just pick Canada this time because Canada came out last week with another hot inflation measure. So they're still bubbling along a pretty high rate, but their lift of rates was not as strong. So they were expected to do 75, they did 50. And it's interesting that now the markets are starting to redefine what a pivot looks like. So previously, the pivot was when rates are cut, right? Now, they're redefining pivots as well when you actually might increase rates but more slowly, right? So
yeah,
saying, oh well, we're into pivot land now. This is why the markets have been reacting very strongly over the last few days.
Yeah.
The question is that really true? The fact that now they're lifting rates is a slower trajectory rather than previously. In other words, remember that normal adjustments are 25 basis points. And, the Fed and the Bank of Canada and New Zealand and even Australia was doing much more than that at a single point. So we're running up very strong rate rises. So it's not surprising that the rate of increase is slowing, but this isn't really a pivot. And unfortunately, I think the markets are still just trying to kid people to crowd back in and, help them out by buying stuff. I'm concerned that some people are actually still being rather misdirected by this, and effectively we are still in a bear market rally, but it could actually decay further, I think.
Yeah, I did a write up in our group a few months ago now, talking about how when the fear of all this inflation, the fear of rate hikes peaks, and the way the sentiment dictates a lot of what happens in markets. And as you say, now that they're even talking about doing it less aggressively or even pausing, that's the new pivot, as you say, rather than actually just cutting and printing money. That's any sign of hope that things aren't going to keep going so aggressively. Markets are sort of cheerleading now.
And they are indeed, and it is interesting because there are still market analysts out there saying we're still in the middle of a bear market, and in the bear market you did get quite strong bull runs in a bear market, but it's still likely to go further. There are others keep calling the end of the bear market and saying, well, you're going to miss it if you don't come in now. Well, just be careful, as I'd say, because I actually think that there's a lot more downside risk here. Rates are going to go higher. The recession risks are still strong. We've got uncertainty in Ukraine, and the latest situations there are not looking good either. Europe's looking pretty sick. Let's be honest about where we are, and I'm afraid that the markets are still, I think, rather spruiking rather than actually telling us full story.
Okay, so the US dollar's still off its highs, but had a bit of a bounce lately.
Yeah. So this is, of course, part of the strategy in the US is to keep the US dollar strong as the, buttressed exchange currency. A lot of international trade done with the US dollar, but it's putting huge pressure on other economies, emerging markets, and even places like Japan, as we'll see in a moment. It's come back a little bit because it's 114 at one stage, but it's still pretty strong. And one of the reasons why the Aussie dollar was very weak earlier on, and it's come back a bit, is because the US dollar is a little bit weaker than it was. But it's worth just underscoring that where the US dollar is has huge impacts on our own economy, because of course we buy a lot of stuff in US dollars, and then if you import it into Australia, you're importing inflation potentially if the dollar is really strong. In emerging markets, many emerging markets are seeing huge rises in the cost of food and other staples, which is stoking inflation and putting more pressure on those emerging markets. And even some more advanced economies, and even places like China and Japan, are seeing the consequence of this very, very strong US dollar. So in a way, the US policy of a strong dollar, which helps their battle with inflation, is being done very much for, internal reasons to support the US economy.
Yeah.
The question is the fallout globally, I think, is quite significant. So to my mind, there are some people still saying, well, the US dollar could run up to 120.
Yeah. You've got the slide about Japan you mentioned before.
Yeah. Now, Japan is an amazing story. Of course, Japan is the last holdout on negative interest rates and ultra low. Now, they've had to buy a lot of dollars effectively to support the yen, but the yen's still knocking on a very high level of exchange rate, up to close to 150 against the US at one stage. But the really interesting thing is that there is going to be a regime change at the central bank in Japan. Kureda is going to leave early next year. And so there's a big speculation now that maybe they will actually give up on their negative interest rate, zero rate strategy. And so there's actually, if you look at the swap prices, this is from Bloomberg, they're predicting that the rates in Japan will actually start rising as soon as he leaves early next year. And if you look at the 2-year Japanese bond, it was knocking on zero, which of course it's been in negative territory for a long time. So a couple of days ago, it was knocking on zero. It's come down a little bit, but the expectation is that maybe Japan will actually change direction once Kureda leaves early next year. But it does put huge pressure on the Japanese economy. They're having to effectively intervene in the markets in quite big ways. Of course, China is intervening in the markets too. They're all trying to defend their currencies against this massively strong US dollar. And in Australia, we've had issues here with our Aussie dollar, coming down quite a lot from where it was earlier because of the strong US. So it's interesting to watch how banks around the world central banks around the world are actually reacting to this. And it puts a lot of pressure, of course, on the central banks, particularly in the context of having to, create capacity to actually buy more bonds, which takes you closer to quantitative easing rather than quantitative tightening. And so the question is, will quantitative tightening really, really start hitting, or will actually they find ways around? And the UK was a classic example where they actually at one stage decided they would actually need to do more intervention in the markets to effectively support the bond markets in the UK. The pension fund in the UK, the $1 trillion of bonds, long-term bonds, were actually getting pretty wobbly because of some leverage issues there. So the Bank of England came in and basically turned turtle on that. And they're still saying they want to do quantitative tightening, but what they're now saying is they'll do quantitative tightening at the short end, but that still leaves them potentially to actually go the other way at the long end. So there's a thing called Operation Twist, which is basically where you actually have different strategies at the short end and the bond end, short end and the long end of the bond markets. You could do both contemporaneously. So whilst it would actually potentially keep the total balance sheet in roughly where it is, you could actually switch it around a bit and try and actually drive long-term rates down, bond rates and prices going in opposite directions, of course. So it shows you that there's a lot going on below the surface here. And this financial plumbing, internationally speaking, is a big problem because it's having significant impacts on the bond markets. The bond markets should be, frankly, non-volatile and boring, but they've been anything but that. They've been highly volatile, and rates have been all over the place. And so a number of people are saying, well, maybe this is where we're going to see the next crisis.
Yeah, and this is the summary with everything that we've just spoken about with bonds in the US. Do you want to share your thoughts, Martin, and then I'll try and tie it all together with a few of the things I think are coming?
Yeah, so it is interesting. If you look at the the bond markets in the US, they've come back a little bit, but it's still interesting that the long bond 10-year compared with the 2-year is still in basically signaling a recession. So the argument is if the short term is actually higher than the long term, 4.4 versus 4, then essentially that shows that there's an expectation in the financial markets that we're going to move into a recession into the US. And that's been in that negative territory now for quite some time. So rates are actually moved up. They've come back a little bit, but mortgage rates in the US that are priced off the long bond are very high now. And that's putting pressure on the housing market in the US, significant pressure. And the cracks are appearing. Liquidity is down. Some people are talking about some players really struggling to find any way of getting the liquidity they need, and therefore there's an argument that maybe the Treasury in the US will actually need to intervene into this Operation Twist to try and actually create more liquidity in the marketplace, which of course is another name for quantitative easing.
Yeah, and that's where I think we could get into this situation where inflation continues to remain hot, but with the bond markets, the way that they're acting at the moment, we're going to see this intervention at different points in the yield curve, or maybe all points in the yield curve, to suppress those rates. And so they're going to start printing more money. We're seeing that the US had to lend to more central banks this month. The Bank of England stepping in $50 billion. So these are the kinds of things you're saying as the pension funds rebalance and the commercial banks get into trouble with liquidity to meet their capital requirements, possibly even forcing them to buy more bonds themselves, but they'll print them the money. Because remember that legally the Fed can't do that themselves. So this is where it's going to be, hey, have some more free money from the money printers, but you've got to do this to help us and to try and artificially suppress yields. And in that situation, we could see things in the real economy like housing continue to decline, but maybe risk assets like the stock market and crypto or other things like that can start to do well, but it's all just this artificial game to try and make things look good because the free money taps have turned on again, whereas the real economy will be suffering.
Absolutely, and the contrast between the real economy and the financial markets is huge. Of course, everyone's worried about the financial markets, and particularly in the Treasury in the US and in the Federal Reserve. But in the real economy, this could be, it could be really horrible because we end up with continued high inflation. Interest rates are still much higher than they were previously, but the real productive economy is getting crushed in the process, and we end up ultimately with more and more of our economic future tied to what happens in these financial markets rather than the real economy, which is stupid. Another observation is there are some people suggesting that maybe that the Treasury and the Federal Reserve will actually get closer together, and maybe more of the functions of what the Federal Reserve currently does might actually find their way into Treasury. It's interesting, of course, that Janet Yellen is sitting there at the head of Treasury, having been, of course, the head of the Federal Reserve previously. So there's a lot going on below the waterline here, and I'm not sure how it's going to play out. But the risks are huge here, right? And unfortunately, the fixation on fixing the financial system and dealing with the volatility in the financial system, as opposed to fixing the real economy, is, for me, the real problem, because in the real world, households and businesses are really struggling. In the real world, we've got big issues that we should be tackling, but no, everyone's wanting to fix the financial system, which is actually not an end in itself, but it's something which should be serving the real economy, which is a million miles from where we currently are.
Yeah, and if they're forcing banks and those people to hold more bonds, they're going to be doing less lending to start new businesses and for real economy things. So that's where you can see that scales tilt even further. So that's an interesting way to think about things. Yeah,
Absolutely.
fantastic. Well, great work as always, Martin. Any final thoughts, or we'll see you again next month?
Well, I'll just finally say this, that there are people saying, "Oh, we're at the end of the bear market. Everything's going to go up from here." I would say, hold on to your hats, folks. There are still many, many more difficult days ahead. The volatility is huge. The financial system is really under the strain at the moment, and central banks will still put rates up further. So don't expect a sudden get out of jail card played anytime soon. This is going to grind into next year. And I suspect we'll be having somewhat similar conversations over the next few months.
Cool. Well, guys, as always, the links to all Martin's social channels are down below. But otherwise, hit that like button, subscribe, share these videos around, and we'll talk to you again next month. Thanks, Martin.
See you. Bye.
See you guys.